Hi friends. In the time I have been trading and checking technical indicators, their results, strategies, technical analysis, I have noticed that some indicators and some strategies perform much better than others. And that's why I recommend you not to try to test everything, not to try to test all the indicators available to you, but to concentrate only on those that have been tested on history and show results better than the others. And in this video, I want to talk to you about 5 strategies that are based on technical indicators, which will allow you to get a higher win rate and a higher percentage of profitable trades and get more profit from it. So, the first indicator I want to talk about is Bill Williams' Alligator. It is an indicator that consists of 3 moving averages with different periods. Bill Williams' classic Alligator strategy tells us that when the green line has crossed all other lines and the alligator has spread. Now the lines do not intersect each other. We have to get in on the deal. This way. Here's a good example here. The green line has crossed the other 2 lines. Now none of them intersect and the lines point upward. That means we have to go into the trade up. Conversely, when the lines cross in the opposite direction and straighten out, we should enter the trade down. But what's the problem with the classic use of Gator? Its main problem is that it reacts too late to price changes. For example, let's take this short-term downtrend right here. Here we have a downtrend, a classic alligator signal. Came in just at this moment. You see, when the green crossed the other 2 lines and the alligator straightened out, that's when we should enter the trade. As you can see, more than half of the trend has already been missed here. We're getting in on the deal too late. So I propose another option to use the alligator. We don't have to wait for all the lines to cross. All we need is for the green alligator line to cross the red line. If it crosses from top to bottom, it is a signal for a down trade. If the green one crosses the red one from bottom to top, it is a signal for an up trade. We exit the trade when the chart is not aligned, but the chart itself crosses the red line, i.e. egg. The first signal is the green line crossed the red line. This is the point at which we got the signal for an up trade. Ideally, we go in at the low point, the chart goes up, up, up. And that's where our stop is triggered. We are taking profits because the chart bar has crossed the red line. It's the same at this point. We enter the trade when the green line crosses the red line. We don't need to wait for the full crossing. We enter the trade here and conduct the trade until the chart crosses the red line. We will fix the profit here. With this strategy, you will get signals much more often than with a regular alligator. And in fact, here are my checks. My tests on history show that it will produce results even better than the classic alligator. Moving on to the second tool. The second tool is exponentially moving with a period of 200. You can install it on the chart through the indicator selection menu, moving average exponential, set to chart, and change the period to 200. We need to go to settings. The default here will be 9. We need to change it to 200. This is what it will look like on the graph. This indicator is very good because it combines well with any other technical indicators. But the classic moving average trading strategy tells us that when our chart is lower than the 200 moving average, we should only open trades down. And when the chart, for example, crosses up to down, we should close the trade down. Conversely, when the chart crosses the 200 moving average from bottom to top, it is a signal for an up trade. But also the moving average can be used as a filtering indicator for any other indicators. For example, we have a basic indicator that gives a signal. For example, it will be MACD, stochastic, or any other parabolic indicator. Maybe it gives the main signal, but through the moving average, we will filter this signal. That is, if the chart is below the moving average, we open trades only downwards. We only use down signals, we skip up signals. Conversely, when the chart is above the 200 moving average, we only use up signals and skip down signals. Let's look at the MACD indicator, which shows the convergence and divergence of moving averages. By the way, the third strategy I recommend to you is a combination of exactly the moving average and the MACD indicator. So the main signal on the MACD indicator is you have a moving average crossover, just like you had with the Alligator when you have a fast moving average. In this case, the beige crosses the orange from top to bottom. This is a signal for a trade down. Conversely, when we have the fast moving beige crosses the yellow from bottom to top, this is a signal for an uptrade. But we're also going to filter it through the moving average. That is, we will enter down only when the chart is below the moving average, and we will enter up only when the chart is above the moving average. So here's a simple demonstration of this strategy. What we have here is a clean down trade signal, and we make sure that the chart at this point is lower than the 200 candle moving average. Both signals coincide, and we enter a good trade down. Here, for example, at this moment, we have a signal for an uptrade. As you can see, the moving average on the MACD has crossed from bottom to top, but it's a signal for an uptrade. But our moving average chart does not confirm this signal. The chart is below the moving line. So that's the signal we're missing. And the signal we use is this one. We have a clear signal from the MACD for an uptrade. There's an intersection. And the chart exactly at this moment crosses the sliding line and is above the sliding line. And this is where we go in at the top and make a nice profit. A very simple strategy that even beginners can use. The third indicator and the third strategy I want to recommend to you is the RSI indicator. It is an indicator, relative strength index, and it is one of the most used technical indicators in the world. What's he good for? I like it because it can be used both to look for chart bounces and to look for new trends. If we use the indicator as for bounces, we should be looking at overbought and oversold zones. The RSI index shows exactly the overbought and oversold zones by default. When the chart approaches the upper boundary of the RSI, it means that the chart is already overbought and a downward movement should start soon. Conversely, when the RSI index approaches a lower point, it means that the chart is oversold, that prices are on average lower than they have been for the period in question, and there may well be an upward move soon. For example, here the RSI indicator has moved into the oversold zone, and we can open a trade up and get a good profit. Here in the overbought zone, the signal is weak here, but even here, you could make a small profit. Also, the chart is moving into overbought territory here, and that means it is higher on average than it has been over the period. Now the price is relatively high, and we can open a trade down. So there should be a correction soon. It is standard to use RSI as an indicator to look for chart bounces, to look for pivot points, but RSI can also be used as a trend indicator, as a supplement to trend following strategies. To do this, we need to set the overbought, oversold line to 50, just like the middle line. As a result, we get a chart like this, where there is a 50 line in the middle. The middle line is the line of the RSI itself. And in this case, we can use it as an alternative to the moving average. When we have RSI below 50, we only enter up trades. So when the RSI indicator is below the 50 line, we only enter trades on the downside. We're missing the up signal. If the RSI is above 50, then we only enter upside trades. And we miss downward signals by other indicators. As I have already said, this is an analog of the moving average from the previous strategy. On its own, it is better not to use this option. You can add any trend indicator, such as parabolic, or for example, Bollinger lines, and we will filter the main signal through this position of RSI above or below 50. Well, the last indicator, which is very underestimated by the market, which almost no one uses, but it provides a lot of information for traders. This is the ATR indicator, True Volume Indicator. What does this indicator show? Unlike other technical indicators, which come in either trend indicators, which look for trends, or oscillators, which look for bounces. This is the third category of indicators. These are volume indicators. It shows how high volatility is in the market right now. If the ATR is small, it means that there is low volatility in the market right now. For example, it shows that the candle is now averaging 155 pips. You can look at the readings above. If we point, we can see that in general, on average, the chart passes 150 pips per candle. And at the point when volatility is already high, the chart passes 370 pips per candle. How is ATR good for us? It is a good warning indicator that will complement any strategy well. For example, in this case, it shows that there is low volatility in the market. We can see the same thing on the graph. See, it's barely wavering, up, down, up, down. In fact, you can't make any profit on such a chart because in general, there are no trading volumes, no good movements, price, and you can't use this chart to make a profit. The real profits are made during trends when volatility is high and the graph moves in a particular direction. And when we see the ATR chart start to pick up volume, you see here the ATR is already starting to rise. That is, volatility appears in the market, and we don't see that on the graph yet. Here is this ATR rise, showing us that there should be a trend either down or up soon. This, by the way, is a very common mistake. Just because ATR is going up, it doesn't mean our graph will go up as well. This means that there is increasing volatility in the market, and there is about to be a strong move either down or up. And you can combine ATR with any previous strategies so you can see in advance at what point to prepare and start looking for good entry points. Because there will soon be a good trend in the market that you can catch with other strategies. And ATR, as I said, is a warning indicator that can be used with any strategy on any asset and on any other time frame. These are the 5 indicators. I advise you to pay attention to them the most because they show very good results, very good win rate. Try to master these indicators and try them in your trading. Share in the comments what indicators you already use. Good luck to everyone and see you soon.